Assalamualaikum warahmatullahi wabarakatuh. Hello and thank you all for attending OKEP Investor Call for the 9 months ending in September 30th, 2025 financial results and operational performance. I am Ridho Wahyudi from Investor Relation Teams. With me today, I have Mr. Mahmud Al-Hasmi, Acting CEO and COO, Mr. Jaber Al-Numani, CFO, and Dr. Anwar Al-Harusi, Chief Executive Commercial. We have an hour scheduled for today's call. We will start with a brief presentation to review OKEP results, and we will then go to a Q&A session. Before we start, a brief disclaimer. In this presentation, we make forward-looking statements that refer to our estimates, plans, and expectations. Actual results and outcomes could differ materially due to a range of factors noted on this slide and in our MSX filings. Please refer to our annual report and MSX filings for more details, all of which are available on our website. And now I will hand over to Mr. Mahmud.
OKEP delivered a strong financial results for the 9 months ending 30th of September 2025, despite the drop in oil price falling by almost $10 comparing to the same period in 2024 due to both geopolitical and supply and demand challenges. Despite the drop in oil price, our strategy was very clear in operation excellency, production enhancements, and cost optimizations, which enable OKEP to deliver a strong return to our shareholders. Over the past 9 months, OKEP generated 425 million Omani riyals adjustment cash flow from our operations, which is 10% higher than the same period in 2024. OKEP continue to be one of the leading energy companies for the return on capital employed of 23% for the first 9 months. For this year, OKEP delivered more than 173 million in base dividends, a total of 44 million performance-based dividend for H1 2025, in which 50% already been paid and the remaining 50% will be paid by end of this month. This is more than 217 million Omani riyals in total dividends so far this year. To further enhance our shareholder returns, our current share buyback program is progressing well. By end of October, we have around 50% of the target share buyback been acquired. This is from me, and now I'll give it to Gaber to give more insight in the performance, financial performance. Thank you.
Thank you, Mahmoud. Good afternoon to you all, and welcome to OKEP 9 months performance of 2025. As you can see in the slides, really OKEP delivered very strong financial performance when it comes to our production, our revenues. And to start with, our oil and condensate volumes has grown up from the same period of last year by almost 12%. The average realized price for the oil and condensate, as mentioned by Mr. Mahmoud, it has really dropped down by almost 13%. However, due to the increase in the oil and condensate sales volumes, always from the cost discipline that the company really has been really putting on target for this year, maintaining our OPEX per barrel less than $10, and also discipline CapEx expenditure, that really helps the company to overcome the drop in the oil price. Our gas sales volumes almost in the same range, as well as the average realized gas sale prices. And that really translated into our revenues, which was almost in line with our results of last year, the 9 months. Our gross profit decreased by almost 7%. We continue to really have very strong, I would say, adjusted cash flow, as mentioned by Mr. Mahmoud, which is almost 10% higher than last year, and that comes really from the strong cash generation that we have, and also the cost discipline that we have been exercising. Our capex grew up by almost 7% due to the completion of the Basat C project in Block 60. Our net profit, as a result, dropped by almost 10%, and that's mainly contributed to the divestment of Abraj, which was basically there last year, which we transferred the ownership of that to our parent company, to OQ, and also the financing cost due to the new term loan that we have taken last year in around September. We continue to generate very strong return on capital employed to our shareholders. So our return on capital employed really stood at around 24%, similar to almost the last, I would say last year. On the following slide, we're showing the Q-on-Q, Q2 to Q3, basically variance and the results. And you can see that really our oil and condensate volumes almost slightly dropped. However, the big impact that impacted our revenue, as I mentioned, is really the decrease in the average realized sale price for the oil and condensate, which dropped by almost $6. Our gas volumes grow up by almost 4%, and accordingly our the sale price for the gas. And that really impacted our financial results and the financial matrices basically in the below statements, which really impacted our revenues. However, as I mentioned, we continue to basically monitor our expenditure, and hence our generated cash flow and also our capex. That has increased, as I mentioned, due to the completion of Basat C. Our net profit really gone up, and the return on capital basically employed as an impact of the revenue has basically went down. When it comes to the cash flow generation, the company really continued to generate very strong cash balance. So we started basically the period as compared to the last 9 months last year with around 160 million Omani Riyal, and we closed the period of this year with almost the same amount, which is equivalent to almost over basically $500 million, and that would really enable us to meet our dividends obligation when it comes to the base dividends, as well as to the performance-based dividends that we declared and we paid for the H1 performance of this year. OQEP continue to be basically the dividend leader, I would say, within MSX market today. We are almost, during this year, we managed to pay around almost 34 paisa per share, which is the highest among all the listed entities within the stock market. And that really demonstrated the ability of the company to be the leader within the Muscat Stock Exchange and also within the companies within the GCC. Which is, I mean, that's able to, as well, after meeting our obligations when it comes to capex expenditure and also setting basically the scene for any growth opportunities that we might have. Now I would hand over to Dr. Anwar to give more insights into our operational overview and operational performance.
Thank you very much, Jaber. From the asset operational side, we just want to highlight that Block 60, our flagship asset, has been delivering as promised. We have completed the Basat C expansion and now is processing nearly 70,000 barrels of oil per day equivalent, with many wells that have been reactivated using this new facility, leading to a production increase of about 10%. Apart from that, in Block 65, where Oxy is the operator and is our partner, we have just signed a gas sales agreement with the IGC, the integrated gas company, to sell some of the associated gas to IGC. We've also signed another agreement with IGC, which is via Marsa LNG. Marsa LNG is the company which is owned partially by OQEP and Total, with OQEP owning 20%, to basically offtake 150 million scf per day gas from Block 10 into the Sohar LNG. We've now signed the gas agreement, which allows that to happen when the plant is ready in 2028. At this moment in time, the LNG facility is being constructed in Sohar and is about 25% or so complete. On partnerships, we've just signed a memorandum of understanding with Petronas, which is the state-owned company in Malaysia, to look at joint investments in Oman and also internationally. From the exploration side, we've continued to work on our exploration assets, including Block 54, where we are just finalizing our extensive evaluation and study program in preparation to have a well entry soon, inshallah, in the block. In Block 47, we've applied for an extension with the operator ENI, and that extension goes for 6 months up to March 26 to allow us evaluate the well which we drilled and completed. We are now evaluating basically that well to see how we take the block further. Next slide. So here we summarize indeed OQEP performance and value generation capability. So in terms of assets, we remind the investors that we do have high quality asset portfolio in partnerships with IOCs, big majors in the country, the likes of Shell, BP, Total, Oxy, and so on. We have been delivering growth and projects in our own operated asset, Block 60, delivering as promised, basically production, reserves, and cash monetization. When it comes to cash flow, indeed, OQEP has been robust in its ability to generate cash. We've been strong in our basically cash generation capability and performance. As my colleague Mr. Jaber explained, we do highlight that we have basically low cost, basically average concession areas and blocks, averaging to less than $10 per barrel oil equivalent. The portfolio is mostly self-funding with basically low leverage. And as Jaber explained, we have been delivering strong dividends and return on capital employed of 23%. We highlight also we have a diverse, seasoned leadership team with our acting CEO, Mr. Mahmoud Al-Hashmi, and the rest of the management team, who have been, showing a strong track record in the industry, in the oil and gas industry in Oman. With this, I'll leave the floor for questions.
Thank you so much, Mr. Mahmoud, Mr. Jaber, and Dr. Anwar. And now we will start our Q&A session. Please raise your hand using the feature in Zoom or write your question in the Q&A box. So now we have the first question coming from Ildar from HSBC. Ildar, please unmute yourself. Thank you.
Yes, thank you so much, and thank you for the presentation and congratulations on strong numbers. Can I just ask about the working capital? There was a slight increase, I think, because of lower payables. Do you expect payables to remain stable until end of the year, or any changes you expect? That would be very useful to hear. And finally, so I'm sorry I missed, I think, the part about the gas production. What was the increase year on year in 3Q in gas production and sales? And finally, you mentioned that there was a 10% increase on Block 60. From what level and from when do you measure this increase? Thank you.
Okay, thank you, Ildar. I think for the first question, Mr. Jaber can.
Yeah. So with regards to working capital, yes, we expect the payables to remain at the same current level that we are having it now for the 9 months.
Okay. For the next second question from Ildar is about the gas sales year on year.
Yeah. So with regards to the gas sales, again, we are expecting it to remain the same at the current levels that we are having, and mainly maybe coming basically this year we had a slight drop where we had the turnaround at Block 61. But going forward, we expect it to be almost in the same range.
The third question from Ildar is about the Block 60 production increase.
So first of all, maybe clarify regarding the gas. For the gas, we're having a fixed gas sale agreements, and we'll be providing the gas based on these GSAs. For Block 60, as mentioned, there's an increase of 10%. So currently, we're doing above 70,000. It used to be around 60,000, so almost around 10,000 BOE increase per day.
Thank you, Mr. Mahmoud. Okay. So the next question will be from Kausik. Kausik, please unmute yourself and please tell your institution as well. Go ahead.
Yeah, I just wanted to know what is the, since it is October, so what will be the kind of average realization for oil this year? My calculation shows around $70.6 per barrel. So will that be the kind of number?
So if I can repeat, you asked about the sensitivity, Kausik?
No. I mean, I just wanted to know the average realization of oil in the current year.
Okay.
It will be around 70.6.
Indeed, Kausik. It is around 70.6, the average realized oil price for the year.
Got it. Thanks.
Okay. Thank you, Kausik. Now I will read question from the Q&A box. The first question coming from Izul. How do you see the volume growth in the next 3 years compared to 2024? Mr.
Yes, thank you for the question. As we said in the past, indeed, OQEP never stops for growth projects and will continue the same growth trajectory as we have demonstrated in the past. At this moment in time, we are evaluating a few projects with the Ministry of Energy, and inshallah, some will be finalized very soon. In terms of in-house projects, Block 60 is being indeed looked at as well, with some developments above the current projects coming up in the next 1 or 2 years. We are also working on our exploration blocks, Block 48, Block 54, and some of these blocks will definitely lead to development projects in the coming years as well. And we have developed basically, we are developing partnerships with partners such as what we've signed with Petronas, and we are evaluating at this moment in time a few ideas. I don't know if Mahmoud wants to add on this.
I think in addition to what Dr. Anwar mentioned, also we're hoping that will be FID Block 11 with Shell next year. And with that, we'll deliver more gas, inshallah, in the coming years.
Okay. Thank you, Dr. Anwar, Mr. Mahmoud. Now I will continue with the Q&A in the chat. The question is coming from Sandes. SETI. I will read. The first question is, on the recent gas agreements, could you clarify the nature of this agreement with IGC for Block 65? Specifically, whether this represents a new offtake contract, and similarly, whether the Marsa LNG gas transport agreement reflects new capacity or a rerouting of existing volumes.
Indeed, good question. On the GSA for Block 65, it's basically a continuation for what the block has been producing and generating. Indeed, it is associated gas from the oil production that has now basically secured in a continuation basis to what we have been selling to IGC. So it will not bring, let's say, more volume. It's a continuation of the existing volume, and that volume is increasing with time. On the Marsa LNG gas sale agreement, indeed, it is also not adding any new gas, if you like. The gas is being sold today to IGC, but this is securing gas for the Marsa LNG once the plant is ready in 2028. At this moment in time, while the plant is being constructed, many agreements are being signed to allow the LNG, basically the delivery of gas to Sohar, and the transportation, and then the processing and selling of the gas. At this moment in time, Marsa is producing its share of 150 million scf per day, which is sold to IGC in yet another basically agreement. I hope this clarifies.
Thank you, Dr. Anwar. Still from SETI, the second question is related to buyback, I think to Mr. Jaber. There was a 45 to 60 million share buyback plan between August 2025 until February 2026. And the balance sheet now shows only around 1.2 million Omani Rial in treasury shares. Could you update us on the progress of the buyback to date, including how many shares have been repurchased and what is the cost?
Yeah, so when it comes to the share buyback, so as of last week, the company achieved almost 50% of the share buyback program at an average cost of around 0.344 Besa. And we're just continuing basically to monitor the market and the share price to achieve basically the target that we set until February next year.
Okay, thank you, Mr. Jaber. So now coming back to the live question, I think I will, Joyce from United, please unmute yourself.
Hi, good afternoon. Thank you, gentlemen, for the opportunity. Just one question on your CapEx. Could you please discuss the reasons behind the rise in CapEx spending during this quarter? And is there any update on your CapEx guidance for the remaining part of this year? And what's the outlook for 2026?
So when it comes to CapEx, the increase in this quarter specifically, as we mentioned, it is due to the completion of Bisat C project in Block 60. However, the guidance for this year remain as is. It is between $0.8 to $0.9 billion, and there is no change basically in the guidance for the upcoming year.
Thank you. Thank you, Mr. Jaber. So, okay, I will read again before we go to live question from Q&A box. The question is from Kausal. What is current production per day from oil and gas? I think to answer this, we have the information in the press release, Kausal. If you can access to our website, you can see our current production. But maybe Mr. Mahmoud wants to add.
I mean, the African production year to date is around 224,000 BOE per day, which is higher than our business plan.
Thank you, Mr. Mahmoud. Okay, now we go back to live question. I think there is follow-up question from Ildar. Please unmute yourself.
Yes, thank you again. Just coming back to question about CapEx, I think you mentioned the gross CapEx guidance. Any chance you could remind us about the net level, what to expect to spend on your accounts, on your cash flow statement for this year, please? And then secondly, I wanted to ask you maybe to share key highlights of your exploration program for the next few quarters, like what kind of work will be done, where, on which blocks, what the key maybe high impact exploration wells you're planning to drill. Thank you.
Yeah, so maybe I'll take the first question, and then I'll hand over to Dr. Anwar to talk about more about exploration. So when it comes to CapEx, as I mentioned, the CapEx expenditure remain as per our plan, between 0.8 to 0.9 billion this year, and there is no change that we anticipate that it will go beyond that number, and hence that the number that we are going to basically see in our cash flow statement at the year end.
In terms of exploration, let me maybe start with Block 54. So Block 54 is a block which we've signed off early this year, and after signing we embarked on geological studies, basically to firm up all the plans for re-entering an existing well. At this moment in time, all the preparation in terms of contracts and in terms of activity to re-enter the well are being finalized. And the well re-entry, I think, will happen sometime in January in 2026 or late December this year. So that well will be re-entered, and basically drilling extension will take place, and then testing. In terms of Block 47, the one that I described, Eni, the operator, has completed the drilling of the exploration well. We have captured logs and data, and at this moment we are analyzing. Both of us, the operator and ourselves, are evaluating all the log data to see whether we go back to the well, make a retest basically in Q1 26, or we take other actions. In terms of exploration and Block 48, we drilled a well lately, and that well is currently under testing, and inshallah we have some basically good news inshallah to come. But at this moment, the testing is ongoing. Otherwise, there are near-field exploration going on in our JV assets, such as Block 9, Block 65, with Occidental. These wells, these fields and blocks have always and continue basically to drill near-field exploration wells, which mostly come with good production, and it's connected and being sold. I think Block 11, as Mr. Mahmoud highlighted, Block 11 we've drilled one well, and now we are drilling the second well for this quarter, and the results will be assessed and shared in Q1 next year. The block is earmarked for finalization sometime in the summer of 2026, and we hope that at that time the operator and the partners, including OQEP, will finalize a development to be sanctioned by the government. I think that's it from our side. Thank you.
Thank you so much. Very useful.
Okay, thank you, Dr. Anwar and Ildar. So now I will read question from James Marriott. The question is, can you provide any insight into resource base of the Blocks 11 discovery? Have you been in discussion over increasing your participation right shares?
Okay, very indeed good question. So Block 11, at this moment in time, we have 10%, and we are paying for the 10% basically share of costs, exploration costs. The idea is if the block is sanctioned in the middle of next year, or maybe Q3 latest next year, then OQEP has the right to basically acquire another 30%, which makes OQEP owning 40%. The block is very prospective. Volumes cannot be disclosed at this moment in time, but they are quite good volumes that we are earmarking. And as the Ministry of Energy highlighted, this block could be a candidate for the so-called LNG investment. So we are yet to see how that will develop, inshallah, with the government. But I hope this answers your questions. Thank you.
Okay, thank you, Dr. Anwar. How about the potential for increasing participation rate, Dr. Anwar?
Yeah, I already said indeed. So once the FDP is sanctioned by the government, we will be lifting our stake from 10% to 40%. And that is, we are waiting basically for the government to sanction the development plan.
Okay, thank you. Okay, continue with, okay, this is not question, but just information. Yes, we have some technical issue about the upload in MSX, but now we already corrected, Safik. And you can also access our full report in our website as well. So we still have time. So if you have any question to our Chief Executive, please raise your hand or write your question in the chat box. Okay. Now we receive question. Okay. Now we see Bisen. Please feel free to unmute yourself to ask the question.
Hi. Good afternoon. Am I audible?
Yes.
Hi. Thank you, team, for a good set of numbers and for the queries of answers so far. Just wanted to check. The business model is basically a cost plus recovery as well as sort of on actuals. Could you give us a split up of sort of what the cost plus model is versus what it is on actuals in terms of where there's a higher share of barrels when the oil price dips? If you could just give us a split if it's possible without getting into details.
Yes, thank you for the question. Indeed, the business model for the oil and gas concessions in Oman is basically similar to, let's say, the global scheme where we have production sharing agreements. And in these agreements, we as a contractor to the government will spend all the costs, and the first thing that happens from the revenue is for the government to set aside basically part of the barrel volumes to pay back the costs. And usually there is a cap per year, if you like, and that cap ranges between, let's say, 60 to 70% or from 50 to 70%, depending on the block. And that is part of the government, let's say, negotiation at the start of the agreement. Apart from that, once the costs are paid, then the remaining barrels are split between the government and the investor. And there is a range as well. The investor takes anything between, let's say, 20 to 40% of the volume produced as a profit for the investor. The rest goes to the government. So usually, in terms of returns, this returns double digits, basically returns to the investor, and including the operator and the partners, basically consortium in each block. I hope this gives you a brief analysis of how this works.
Yeah, it explains the structure. Thanks for the clarity. But in terms of sort of, is this across every single block that you operate, or in some cases there is an offset where if the oil price is below a certain cost level, then you have a sort of larger share from the government? Just wanted to understand that part.
Yeah, exactly. I'm sorry. Indeed. So because you have barrels allocated to pay back costs, if the oil price is low, then indeed you may be allocated basically more barrels to pay back your cost, which you spent. So your costs are related to barrels, but then if the oil price is low, you will need more barrels. If the oil price is high, you will need less barrels. But in the end, it's the same concept. All your costs are to be paid back from the production.
Noted. And that's sort of the basis for my next query. Now, last year oil price was on average about $80 a barrel. We started the year well, but we're sort of averaging, early 70s for the oil price. Now, we've seen, at least in second quarter as well as third quarter, a higher number of barrels being allocated, whilst the oil price is still above $70 a barrel on average, right? Now, that intuitively tells me that anywhere between, sub 75, there is a high allocation of barrels on a cost side. Is that assumption correct, or is there some other way to look at this? Because I'm looking at higher barrels being allocated on a cost basis. On a cost recovery basis, the moment oil price falls below 75 or 70-ish, I'm seeing higher barrels being allocated. So if you could just confirm that understanding, please, firstly.
I mean, that is broadly correct. But remember, there's a lot of details. Each block is different. Each cost, basically, repayment is, the amount is different. The percentage is different. There is a cap to how much barrels are allocated, if you like, for each block. So it's a bit complicated, but the general scheme is correct. I mean, the government needs to pay back your costs, and this is done in the way I explained.
Noted. And final question on the same topic is, for the cost sort of recovery, model, would there be an average price across your barrels? I understand each block is different, etc. But on average, or at least for the broader, for a greater percentage of the blocks that you operate, is there a sort of oil price at which you sort of break even on your cost and you don't require extra sort of barrels from the government? Would that, I'm just trying to conceptually understand different sensitivities on a cost side. This has nothing to do with, free cash flow or dividends. But on a cost side, at what oil price sort of do the operators make enough cash flow to recover the cost versus sort of extra allocation from the government?
So to make it clear, there is no additional things from the government. It's the EBSA which control the relation between the contractors and the governments. And for your question, so if you look to our assets, as we mentioned in the presentations, our OPEX per barrel is less than $10 per barrel, BOE, for the first 9 months. So that's the average of all the producing assets we have, which is one of the top here in Oman and also internationally. If you look to the cost, it's both including, what we are recovering, the barrels, it's including all the cost recovery, plus also the profit shares. Both of them, they are changing depending on the oil price. It's not fixed.
Okay, thank you, Mr. Mahmoud and Dr. Anwar. Okay, we have one live question. Okay, from Ildar. Go ahead. I think this is the last question, from you. Go ahead, Ildar.
Yes, thank you again. Just a quick technical question from me, please. I've noticed that there is an income flow in your P&L coming from Masra JV. I was a bit surprised actually when I first saw it, because I thought it's an LNG project and there is nothing yet. But yet, there are financials, revenue, depreciation, taxes, and stuff paid. What's the nature of this income? Is it like Block 10, a share in Block 10, or it's something else? Thank you.
Yeah, indeed, Eldar, it is our share in Block 10. So currently, until Marsa, the LNG bunkering facility is ready by the year 2028. Marsa enjoying basically the monetization of that gas coming from Block 10. And hence, basically, you see in our financials, our share of equity, which is 20%, belongs to OQEP, basically in Marsa, that's showing in our financials as other income.
Understood. Thank you so much.
Thank you, Ildar and Mr. Jaber. Okay, there is a clarification question from Muhammad. The question is, can you highlight the oil sales agreement and the price realization of T+2 formula, and how does it work exactly?
Yeah, maybe I'll indeed comment on that. First of all, let's talk about the price realization indeed. So the ministry issues the price, which basically determines all the pricing of the oil to pay back, costs. So even for the earlier question, the ministry has a publication every month on the price. And when we say the T+2, indeed, usually our oil is sold via our trading arm, OQ Trading. And the way it is sold is that it's sold basically 2 months in advance. And that price get locked up 2 months in advance. And it's sold indeed in the Dubai Mercantile Exchange. So I hope this clarifies the question.
Thank you, Dr. Anwar, and thank you, Muhammad, for the question. So we still have time. Okay. Okay, if there is no question from the floor, I think we can conclude our sessions today. Thank you for coming to our earnings call. And if you have any follow-up question, please contact Investor Relations team. You can find our details on the IR website. And a transcript of this call will also be made available on our website soon this week. Thanks again and goodbye. Thank you.